It's no secret that the rich keep getting richer. According to Forbes magazine, the collective wealth of Australia's top 50 people is $308 billion. And now that's a whopping 70% more than the figure at 2019, which was $181 billion. We can also see from ATO data that 32% of companies paid no tax in Australia in the 2021 tax year. Now, I'm not here to rich shame because there's no doubt that these people have worked their asses off to get to a position like that one. And many of the strategies might not even be applicable to you. That being said, I've got a strategy which I feel is super powerful and I've seen a lot of people utilize to pay incredible low amount of tax in Australia, and this is strictly domestic tax. If this is your first time here, my name is Mark Mansour and I am the Managing Director of Worldwide Advisory. We help people reduce their tax worldwide and protect their assets, putting you in a better position than when we found you. The most common strategy to pay an overall less tax is always a combination of multiple other strategies, which I'll discuss today. These strategies have long-term vision in mind and revolve around business and entrepreneurship. So first thing is getting your strategic structure done from the outset. As always, it needs to be tailored to you and your personal unique circumstances. And so please understand that this video does not constitute financial or tax advice for you because we don't know about your situation. So we can't provide tax advice because it always needs to be revolved around your personal circumstances. Okay, so with strategic structuring, what we do is we look at find a suitable tax and business structure that works for you. And in this case, what we'll do is we'll go for one of the most simple ones where you have your operations running via an Australian company with your shares in that company held within a discretionary trust. And so this provides asset protection and flexibility. After we set up the structure, we now look at the business. And the trick here is not to make a profit, because you only get taxed on profits and you won't get taxed if you don't make any money. But that being said, what you want to do is you want to continually be reinvesting in your business. So grow your revenue as much as you can, but grow your expenses in the time being. And so whether or not you're spending money on, say, marketing and advertising, hiring new staff, presenting your staff with more incentives, utilizing technology, equipment, investing in research and development, the important thing here is to find expenses and business deductions that will actually improve and grow your business. Year on year, this provides you with an opportunity to give back to people while also putting your business in a forward position. While some profit is inevitable, it can lead to you paying a salary which will be below the current company tax rate. It can also then lead to you being able to pay yourself dividends, which are already taxed on. Okay, so now this is where it gets fun, and this is where a lot of people are unaware of what can be done to the next steps. And unfortunately, a lot of other tax advisors do not go ahead and push and utilize the next steps. What you can do is, now that your business has grown to a certain stage, is borrow and get yourself into good debt to continually facilitate the growth of your business. And the beauty of this good debt is that the interest expense of this good debt is going to be a tax deduction. So you may need to borrow some money for working capital procedures, or borrow some money for you to reinvest even more. And so by continually leveraging your business and continually claiming tax deductions for your interest payments, you can then reduce your overall tax exposure. Okay, and so now this is taking it to the next level on your partial or your exit from the business. you can significantly reduce your taxes. So if we go back to the structure of the company with its shares being held in a trust, what will happen here is if you're in that situation and you end up selling your business, what you will do is you'll be able to get multiple capital gains tax concessions. And so the main capital gains tax concession that you would see is your 50% discount if you held your asset for more than 12 months. So in this scenario, you would have held your asset more likely than not, hold your business for more than 12 months, and so you'll get a 50% discount on the sale of that one. There are some other not so famous small business tax concessions. One of them, and the most easily to access, is a 50% active asset reduction. And so the purpose of this video is not to get into these specific rules and eligibility, but know that you may be eligible to access further small business capital gains tax concessions. There are four, and the one we'll talk about today is the 50% active asset reduction. Okay, so with these, so let's say you end up selling your business for a fantastic figure of $10 million. You won't pay tax on that $10 million gain. Okay, so what we'll do is with the 50% CGT discount, that gain will go from 10 million to 5 million. And then the further 50% small business reduction will reduce it to $2.5 million gain. And so if you held your shares, as we discussed, in a trust, you've got a bit of discretion to put that money across into certain areas. With that $2.5 million gain, the largest amount of tax you can pay on that one, if done strategically and sending that to another company, is 25%. So 25% of a $2.5 million gain turns out to become $625,000. And when we look at paying a $625,000 tax on a $10 million gain, that is only about a 6.25% tax rate. And that can even potentially be reduced further if you distribute to individuals utilizing their progressive tax rate as opposed to a flat 25% corporate tax rate. And so obviously this is really complex tax structuring, and executing this precisely is really important. Okay, as I mentioned before, this is not any advice, it's just letting you know what options are available out there that the wealthy and the rich utilize to reduce their tax. If you think a 6.25% tax rate is excessive and you want to depart Australia indefinitely and potentially to pay 0% tax in Australia and 0% tax in the world, I recommend reaching out. This is our bread and butter. We did a video on this, which I highly recommend watching, is here. Do not hesitate to ever reach out. Thank you.